Volatility and risk are not the same thing, and I am tired of financial advisors and money influencers and online gurus pretending like they are because it is costing people millions of dollars who follow their advice. Just look at this headline that popped up from a quick Google search about volatility and risk from Investopedia that is conflating the two with the financial term beta, implying that in order to be able to analyze a stock's risk, then its volatility measured by beta would be lower. Now, if you don't know who I am, my name is Joe Brown. I am a former stockbroker who spent years advising the top 1% on how to manage their wealth. I made enough money to leave that world behind. Now I teach people financial strategies that exist outside the mainstream because I was tired of people paying too much money for subpar advice where they just slam you into some index funds and scoop 2% off the top for life for giving you a 60-40 portfolio and calling it a day. And if you've ever spoken with a financial advisor, I guarantee you one of the first 5 questions they asked you is, what is your risk tolerance? And I don't blame them because they have to ask this question. If they don't, they could get fired. And if their company doesn't make them, they could lose all their financial licenses. Because at the end of the day, this is just a scheme to get cheap borrowing funneled over to the US government in the form of buying bonds. And let's be honest, nobody likes risk. It is inherent. It's in our DNA. We are built to want to avoid risk. So when somebody that you're supposed to trust asks you whether you want to risk your hard-earned cash or have it in something safe, obviously, if you don't know any better, you're gonna go the safe route. So people get scammed, they stick their money in a 60-40 portfolio for life, missing out on millions of gains over their investing career. And the irony here is that this type of investing actually exposes people to more real risk because they don't realize, number one, that volatility itself is something to be utilized, something to be captured, something to be harnessed and not avoided. And the things that have less volatility, many times just more risk in disguise. Let's take a look at something that historically was one of the least volatile things in history, and that was the price of the dollar, or in other words, the price of gold. This thing, 1 ounce of gold, was worth 35 paper dollars. For decades. You could count on it. You could build your life on it. You could save on it. And in fact, that's what entire nations did. But many times when there's a lack of volatility, meaning 1 ounce of gold equals 35 pieces of paper, many times that lack of volatility is the real risk just being suppressed. And as you all probably know how that story ends, the US government printed way more paper and shipped it all over the world than there was actual gold in the vault to back it up. When the rest of the world realized this and started sending their US dollars back to the government and saying, give me the gold because on the paper it says I can redeem this for gold, the US was about to run out of gold and they closed down the gold window and they decided not to give the rest of the world the gold, ending the gold standard forever because there's nothing as permanent as a temporary government program. And so a lack of volatility is many times real risk being suppressed. And if you get on the wrong side of that trade, it exposes you to blow up, just like it exposed every person and nation in the world who is holding dollars instead of gold. Bringing us to today where this thing, you need $2,300 pieces of paper in order to get the same exact thing that only used to need 35. And if you're interested in learning how to capture explosive moves in the market that happen all over the market and all the time, I'm hosting an asymmetric trading masterclass in just 2 days. Now, it's completely free, but spots are filling up fast. Last time I hosted one of these masterclasses, we had more than 6,000 people register for the event. That was more people than could fit on the Zoom call. Now, over the last year, I've been using a simple and easy to follow system to spot asymmetric trades in my own account, and I've been able to take home massive profits as a result. And in 2 days, this Thursday, 7 p.m. Eastern time, August 15th, I plan on sharing everything I know with you about how to use this protocol to capture volatility, both to protect your account from real risk and increase your gains. This is your last chance to sign up. I know you're going to love it. Click the link in the description below to sign up, submit your name and email. And the only thing I ask is that you show up 12 minutes early, because with so many people registered for this event, everybody tries to get in right at the last second. It could cause some tech issues for people trying to get in. So just show up early, click the link, sign up. I'm really looking forward to seeing you there. On the other hand, let's take a look at something else kind of on the other side of the spectrum that is incredibly volatile. This is a chart of the VIX. The VIX is the volatility index. And so kind of funny because volatility is actually in the name. This is an index that is calculated based off of the volatility of the stock market. And as you can see, this thing can be wildly volatile. It gets as low as about 9 and regularly jumps up to levels of 20 or 30, and sometimes even reaches levels of 80 or higher. So this thing is incredibly volatile, but does it mean that it's risky? Well, not necessarily. Number one, using this effectively, you can actually decrease your downside on your portfolio. So if you decrease your downside risk, you are decreasing your risk. Your portfolio's less risky, not more. Not only can it hedge your downside, using it effectively can also make you money when you big profits instead of just decreasing downside. And in fact, in reality, most things that are incredibly volatile are volatile because there is real active value seeking going on. There's price discovery happening, and that mass market psychological behavior is being expressed in the price moving up and down wildly as people jump in at bottoms, driving the price higher, jump in at tops, driving the price lower, barrel out at the bottoms, driving the price even lower as active price discovery is happening, which means any risk that there is instantly realized in the price as the market consensus moves that price up and down. And if that information is being priced in, then as an investor, it gives you the ability to actually buy something above or below its true value, to sell something above or below its true value. In other words, volatility gives you the opportunity to be a value investor or to be a successful trader. Volatility is something to be harnessed, not something to be avoided. Now, obviously this works for traders. If you are an active trader, a swing trader, I'm not even talking about day traders. Obviously it works for day traders, but if you're just an active trader, this works for you. But most people stop there and think, I don't want to be a trader. I want to be an investor. I want to be a value investor, understand fundamentals, and buy stocks forever like Warren Buffett. Everything we're describing is what Warren Buffett talks about when he talks about Mr. Market. That all the panic selling, all of the FOMO buying, all the volatility that is expressed in markets as people pile in and rush out that makes stocks become wildly overvalued and wildly undervalued. This is what allows for value investing. It allows for the inefficiencies in the market. It allows for you to be able to buy something at a discount to its intrinsic value. And most importantly, it allows you to sell when something is wildly overvalued as well. Whether you want to be an active trader or a long-term value investor, you have to fall in love with volatility. So what about risk? What is real risk? Risk is simply the worst case scenario. Now, obviously, theoretically, the worst case scenario on any investment is that it goes to zero. If you're using leverage or margin, then you could lose more than what you put in. But that's not reality in most cases. I mean, what are the odds that tomorrow we're gonna wake up and Apple is going to be worth zero? Tim Cook could literally do anything. The entire team could stand up and walk away. It's probably next to impossible for the company Apple to be worth absolutely zero tomorrow. Because at the end of the day, they have a bunch of assets. They have factories. They have intellectual property. They have a bunch of stuff that's actually worth something to the market that they could sell off. This is called book value. It's the value of a company if everything went horribly wrong and they had to shut down and liquidate all their assets, how much you would get back as a shareholder. And so in a real world example, a worst case scenario would probably be something crazy like that, of a company just waking up one day and having to close down and sell off all their assets, which means worst case scenario is not even total loss in that scenario. This means that you do have the ability to mitigate your downside risk, to protect yourself from the largest potential loss, the worst case scenario. If you are a value investor, you're looking at Apple or Amazon or any other company, you can buy with a margin of safety. You can study the fundamentals. You can look at the price at which it would be a discount to its intrinsic value. You can buy it at that price. That limits your downside risk because you're already buying it on sale. If you're a day trader, you can mitigate your downside risk by using stops so that if there's a flash crash, it automatically gets you out, by closing out all of your positions at the end of the day so you don't have the risk of a market gapping up or down overnight and you not being able to open or close positions. If you've just got a regular portfolio with some active trading and some longer term investments, you can protect your downside risk by using derivatives, by buying assets that increase in value if the rest of your portfolio goes down. This allows you to protect your total portfolio value. It allows you to have dry powder to be able to buy assets when they're on sale. There are plenty of ways to do this, but the key is you can't just bury your head in the sand. Just keep buying and hoping that the index continues to go up is not a strategy. It's just a gamble. As always, thanks so much for watching. Have a great day.